Gentlemen, we will begin now. Thank you for your patience, and I hope you're excited about our next panel discussion, which is all about strengthening portfolio investment. We'll explore the art of making sound investment decisions, the do's and don'ts. Let's get to know our panelists for this conversation. We've got Charles Boon, the Senior Investment Consultant from Kenanga Investors Berhad. Joining him, we have Mohamed Belqaizi, the CEO of Maybank Islamic Asset Management, Sdn Berhad. And finally, we have Jerry Lee, the Manager of Portfolio Management at iFast Capital, Sdn Berhad. And moderating this discussion is Mr. Andrew Wong, Executive Chairman of Avian Capital, Sdn Berhad. Please join me to give them a big round of applause.
I think I chose the wrong place to sit because the two lights are really blazing in my eyes. Very good afternoon to everybody here. I know the worst session is the one that's after lunch. So I hope you guys had a lot of coffee. To reiterate, I wasn't here this morning. Allow me to say that no investment is risk-free. I'm sure all of you know it. And the uncertainty is definitely inherent in the industry. So if you look at the three distinguished panelists, look pretty stressed. Not because they are answering your questions. They had a hard time for the last 1 week, as each and every one of you know. I'm not going to ask the difficult questions. They are. And if there's any difficult questions coming from me, it's my staff preparing the Q&A for me. So I'm going to start off with the first question. And after that, everyone or any one of you, born and welcome to put in your questions to the Q&A. And I will just read it out. Let me just start off with something very simple. It's a volatile time. All of you know it. What should fund managers do currently to protect and lower the volatility of the portfolio? And since this morning we talked about AI as well, do any one of you in your company use AI to do the background preparation? Bell asked me to ask the two of you first, okay? He bought me a cup of coffee, so the two of you, anyone can answer first. Bell, you will be the last.
Okay, yeah. Let me take the questions first. I think in terms of managing volatility of the portfolio, at the first stage, I think what we need to really look at is the mandate of the investment portfolio. So for example, let me give a few examples. For example, first one, if you are managing a pure tech portfolio, so there's no way that we can hide. The mandate itself is asking fund managers and portfolio managers to invest in the tech space. So I think what the so-called asset manager can do is actually to look for high-quality tech companies. So at this kind of environment, we should actually avoid those loss-making technology companies, those smaller caps kind of tech companies. So that's one of the examples. And the other end of it, if you are managing a globally well-diversified portfolio, definitely there's a way to look for asset class with a low correlation to hedge. Like for example, if you look at on the global context, right, look into the fixed income space. I think Malaysia bonds play a very important role when it comes to diversifying the risk of the overall portfolio. So for example, if you look at last year, your global bond as a whole have a decline of about 14 to 15%. But if you look at local bond itself, they are relatively flat or even has a positive of 0.5 to 1%. So we should actually look for asset class that were able to reduce the volatility of the portfolio, lower down the correlation. Because we know when it comes to investment, right, sometimes it's not that the volatility in the market, or it's not that the investing itself is challenging. Sometimes what is challenging is because of the emotion of investors. They couldn't take those kind of a drawdown in the markets. And when portfolio drop 15 to 20%, they sort of afraid and start to redeem their investment. But so as asset managers or money managers, our role is really to smoothen out the journey for investors. So those are the way that we usually do to actually reduce the volatility of the overall portfolios.
So Jerry, to sum it all, I guess, you need to know your clients. You need to assess their risk tolerance. You need to keep reminding them that it's a long-term game. You might want to switch some of your high beta, high volatile portfolios to something more stable, like you mentioned, bond market, and take a long-term perspective, right? Anybody wants to?
Yeah, if I can add, I think, you made up a good point. Sometimes it depends on the mandate, right? So if a fund manager is stuck with a global tech fund, it's very hard for them to manage volatility. right? Because I think diversification has been a very good tool, a very effective tool still. But you cannot diversify when you're investing only in global tech. So to diversify across asset classes doesn't exist. You have to diversify within the asset class. So you have to diversify the country, sector, quality, even style, concentration, etc., etc. But what we do as a fund manager, or fund managers in general, when we have the opportunity to diversify across asset classes, that's great. Because again, every asset class reacts differently with each other, right? I do agree to a certain extent. For example, traditionally, you have your negative correlation between equity and fixed income, but for the past 2 years has not been it, lah, right? It has been quite, everything goes in the same direction. So we do, on my side, we do look at other asset class, that has a bit more negative correlation to manage volatility or manage risk, not the same thing, yeah? So we can even go to private assets, for example. But it is not accessible to a lot of people. Private assets are mainly for institutions, high net worth, so you can diversify for them. But people in the retail space, individuals, a bit tough. And another thing, when you talk about AI, or for me, we are developing AI and quant, it's in terms of the style to manage the portfolio itself, right? Back in the day, when you have multi-asset portfolios, you rebalance periodically, whether it's annually, quarterly, but today, there's dynamic asset allocation, there's active rebalancing. So fund managers use that tools quite a lot. Because in theory, if you have an active rebalancing style, you have a dynamic asset allocation parameter, you can rebalance your portfolio every single day. So not only you're diversifying equities, fixed income, commodities, whatever it may be, you are also changing the weights, your exposure through this asset class differently at any point of time, seeking the right mix of assets at any given point of time. That's one way. And having quant and AI to basically give you the signals to determine you invest in more in gold, more in equities, more in fixed income, it does help a lot. It makes things very active, very fast. Or you can we even use a volatility cap approach, where we manage a fund and we impose a vol cap onto the portfolio, say 10%. So anytime the portfolio breaches that 10%, then we sell the risky assets and we buy low vol assets like cash, fixed income. And then we use that cash to buy back the risky asset, but not going over that vol cap. So that's another way as well. But when you do that, sometimes you are giving up on returns, right? Because higher risk, higher reward. So if you cap your risk, you'll cap your reward. So those are certain things. And again, active management is always, for me, I'm a fundamentalist, it's always great. But using quant or AI to support your active management does make you like a superpower, right? You can really read markets faster, you can rebalance faster. So that's how you can manage the volatility and the risk as well for your portfolios. Yeah.
I will think on the so-called, because Jerry has been talked about on the longer end. Bell has been talked about on the AIs and also the asset allocation. So I will talk about on the shorter end. So what happens now as the morning have you gone through on the market outlook is towards shorter, you have more uncertainties because of the so-called high interest rate cycles. You have tightening process is still in place. You have all the geopolitical tension is still there. So in longer run, we know that funds for unit trust fund or for any assets is actually you will do well, okay, in a smoother path in the longer process. Longer tenures, but in shorter tenures. So what fund managers? Because I'm not fund managers, but I speak in macro side. What the funds we should do is actually more towards we take the so-called the opportunity on the yield curve inversion, I will say, because now yield curve inversion is still there. I speak on the US. So when the yield curve inversions, that means that the longer tenure on the assets is actually making not less attractive compared with the shorter tenure, so especially on cash portions. So on the fund basis, be it equity funds or be it tech funds or be it bond funds, what we can do is actually try to lower down the exposure. I mean, the tenure, the exposure. You shorten like the bond funds. You should, talk about shorter tenure, and rather than you go for longer tenure. Okay, in equities, you look for those more defensive type of stocks. Be it so-called you have a high qualities and also high valuation type of stocks that to so-called mitigate through the volatility in this short period until the so-called the yield curve inversion that has been done in the developed market get normalized. So then your longer term type of investments, tenure like those are long-term growth equities, your real estates, then will be deemed back to more attractive. But this process will need to be done, so-called yield curve normalization. So when yield curve normalization in the process, you will see that the longer term type of assets will be deemed more volatile. So then in a shorter run, I would believe that we should go for more towards so-called short tenure, shorter, more qualities type of things.
Very interesting. I picked up a few things, and I'm glad I'm no longer actively managing funds, just sitting on board and asking questions. Number one is that I noticed that the Bell said about volatility cap. Basically, knowing what is the risk tolerance, stressing the portfolio, making sure that you protect the downside. And so I think the AI and the quant side help a lot. Now, when I was working actively, I say this with all respect, compliance was a pain in my side. But now that I've switched over on the audit side, I think that they are a blessing. You can't do without them. So what do the three of you think, or where does compliance fit in? Or do they have a role to tell you that you have breached the risk gap, you're going to sell this portion, I know you love this stock. What are the policies that each of you employ to manage this? Anyone can go first.
I'll start this time. Yeah, compliance is important. I do think they are a pain, but we need them, right? So, for example, that vol cap strategy that we have, it is important to have compliance. Because sometimes fund managers, like Jerry mentioned, can be very emotional. They like the stock for whatever reason. Sometimes the stock has gone through a series of volatility, but they still want to keep it. So if you have a vol cap, that the compliance acts like a control. It's like, hey, fund manager, your portfolio now is 12, 13% volatility. The portfolio is only capped at 10. So they act like a control. That's one thing. And then, of course, in these bad market conditions, I think for the past 2.5 years, we've been experiencing this really disappointing and depressing market. Fund managers tend to want to sniff for ideas, right? They want to find the jewel within the rough. And sometimes they get manipulated, right? When everything is so bad, you meet this company bad, that company bad, this company bad. So sometimes the one company, my company very good. So you get all the positive stories. The earnings are great, the financial statements are great, balance sheet great, cash flow great. So you want to invest in it. So then for us, for example, I think for all fund managers, you need compliance to do the due diligence before you can even include that stock into your universe. So for the fund manager, because you're blinded with all the potential of this company, sometimes you miss who's the management, who's the board of director, who's the owner. You need to do that due diligence. That's where compliance comes to the picture. Because the worst thing you can do in this kind of market, when things are so bad, your portfolio is down 20, 30%, and then suddenly you sniff an idea, you invest, and then from bad becomes worse. So compliance helps with us with that control, right? Because fund managers, sometimes they are cowboy, right? Especially small cap guys. They want to buy this lah, buy that lah, but compliance keep them in check. So I do think they play a very big role, especially now, right? You want quality companies, you want also to invest in the right companies. So that's where it's quite important for me.
What about cut loss policy? What about defined buy list? Do you allow your guys to buy before you put it up on official buy list. I mean, what do you favor? Don't take the cowboy side now. Let's take a more rational approach.
On our side, we don't allow it. All stocks needs to get approved by an investment committee to be included into the universe. They can get special approval, but they have to go through the process either way. So on a cut loss policies and everything, it's all defined already in the investment process, and they have to follow it. So if they don't, they need to justify why. We do have some leeway, say if it's a significant or one-off event, then we'll have to monitor, the compliance would have to monitor together with the risk team over the next 2-3 months, you need to get rid of it, etc., etc. So that's all imposed. We can't allow, I mean, at least on our side here, we can't allow people just to buy whatever they want, because again, we might be motivated to buy to fix our portfolio to generate more returns, but sometimes controls needs to be there.
Jerry, Charles?
Yeah. Maybe I give a different perspective from asset allocation perspective, right? Because we are doing more on asset allocation. So I think when it comes to our risk parameters, our policy itself, we do have certain risk parameters to say that certain percentage of exposure to a certain region. So I give one of the example that I think it's pretty relevant to a lot of the agents here. If you think about one of the things that we have noticed over the years, especially for the past 3 years, we had a very bad environment and also markets for China equities, right? But I think throughout the past 3 years, if you met a lot of different kind of fund managers or even the local fund managers from China itself, they are telling you a lot of great story. And from a lot of investor perspective, they will say that initially they saw China as a tactical position, let's say 5% of my portfolio allocation. But after years of decline, maybe decline for 5%, 10%, 20%. Investors start to, because we always cultivate the habits of regular RSP or average down. So people tend to average down on the exposure that have been declining. And without you noticing it, the 5% exposure can run up to 30-40% of your total portfolio exposure. So I think compliance play a very, very important role to check the exposure of a single market, single region in the portfolio. Because you don't want to end up having too much of exposure just because that you want to dollar cost the particular exposure in your portfolio. So I think those are also things that we are practicing in our firm. No matter how much we like the single region or single country, we couldn't go beyond a certain percentage. That's the limit. No matter how attractive it is. Look at it at China. I mean, 2 years ago, we have been telling China is very attractive. I mean, 1 year ago, we've been telling China is very attractive. But look at it, down 40%, down 50%, and things might continue to get worse. I mean, no one knows what's going to happen in the next 1 or 2 years. But we need to manage the risk for the money that we are managing. So I think those is something very important. As like you mentioned, it's really a pain point for us managing a portfolio. Compliance is really a pain point. But on the other end, we can see that it really helps to manage the risk that we are taking for clients.
I like the thing that you stress about limiting the exposure on country allocation or in sector allocation. I think that's absolutely necessary. Otherwise, fund managers are cowboys. They like something, they could have 80% of their portfolio in China, and the benchmark is never that high, depending on which side of the curve you are. I like to go to Charles because he mentioned something about bonds and fixed income and so on and so forth. You know, in the bond market, when credit turns south, you can't get out. You know, nobody will buy it off from you. Just look at the country garden bonds. I mean, 60 cents, somebody was telling me, it's cheap. Then it went down to 18 cents or 20 cents or something like that, you know. And then you really put it to sleep because you can't see it for a long, long time. So what do portfolio managers, how do they control the do's and the don'ts, especially on the fixed income side? Because we talked a lot about the equity side. We need to be fair also that fixed income is also a big portion of your portfolio, you see, for any investment.
I would say when we talk about, not only for portfolio managers, in fact, for investors as well. So when we talk about risk and rewards, what comes first is actually always risk comes first. So we need to manage the risk as what my dear panelists also, my colleagues, my panelists also say on the risk. The compliance actually taking gate guard on the risk. So come back to the bond itself. In fact, every fund we mean those fund that fund manager manage, right? They do have the mandates, be it equity funds or bond funds. So for bond funds, what is actually the major mandate is actually you need to be followed. So the fund manager need to follow by the guidance. So if anything to do with overexposed, then that is actually you are taking the excessive risk. Okay, so that I would say that if excessive risk is there, of course reward will be there if that is actually upside. But a downside that would be grateful as well. So, okay, so talk about come to bond mandates. So I believe fund manager will be as similar as what equities need to be done as well. So need to be guided by the so-called exposures, the mandates, the strategies, what you can do and what you can't do. I would say try not to overexpose the risk. The first don't is actually what I talked too much already is actually don't overexpose the risk. Okay, do actually really so-called get rebalancing, I would say, or review or rebalancing on the portfolio itself, not only for investors, for fund manager. We did actually talk about rebalancing. If the interest rate environment is not right, okay, expectation is actually not in line. What the fund manager need to do is actually you need to really do rebalance. A regular review on the strategy that either you go well or go wrong. So if you go wrong, as what Jerry said, don't try to do dollar cost, especially on bond as well. You need to understand that whether or not it's actually the strategy is not right or the view is not right. Okay, so try to emulate and correct it. Okay, so correct it within some so-called the strategy and mandate itself. Yeah.
I guess, which means to say that you need to have strong credit committee to make sure that whatever's in that portfolio is in line with the risk profiling of the bond return, so that if it's high risk, you have more single A, you also need to be careful, right? Yeah. Or if it's a more risk adverse, then you will have more AAA, AA. But I guess what you're trying to say, Charles, is that you really need a strong risk committee. Just like in the equity side, you really need to have research people that like numbers, that like to read. If they don't do that, then I think they're in big trouble. Are there any questions from the floor that you are interested to ask the panelists?
Maybe I try to add on a little bit on the fixed income side, right? Yeah. And also to share our perspective when we are assessing a fixed income funds. So I think, like you mentioned about Country Gardens is one of the exposure that recently really things have gone haywire and so on. So what we usually do when we assessing a fixed income fund is that we've tried to make sure that the fund itself, right, they have a diversified exposure towards different issuance, different issuer. So for example, we don't want the funds that having too high exposure to a single issuer, let's say 20%, 25%. So those are really a red flag to us. So when we are assessing and putting a fixed income fund into our portfolio, we should to make sure that the single exposure, if possible, they can be managing around 4 to 5% on a single issuer level. So anything happen, if that particular issuer really go with default, the impact to your portfolio is only about 4-5%. So that one is still manageable. In fact, if you look at on the opposite, if you have a 20% to a single issuer, if anything happened to the issuer, there's a 20% drawdown to your fixed income fund. And if you want a fixed income fund to recover 20%, it might take you 4 years to 5 years. If you look at the yield for Malaysia, if 4 to 5%, it might take you 4-5 years to really recover that kind of losses. So I think those are important factors for investors to look at, especially when you're assessing a fixed income fund.
Yeah, I think the nightmare for fixed income fund managers is that if you have if you have a country garden bond in your portfolio and you have 20%, and then your portfolio lose 18% of the value, then you want to redeem, the poor fund manager will have to sell all his winners and all his good ones. At the end of the day, you're left with your bad ones, and without cash and without able to switch, there's no way you can turn around the portfolio. Fund managers are not gods. They still need to depend on what's available out there in the market. Okay, I'm going to go through the questions. What research and analysis technique do you and your team employ to identify potential investment opportunities? Anybody is free to answer the question except me.
I start first. Okay. So my research, we talk about for investors. Okay, investors' perspective. So to identify the investment opportunities, first of all, we need to understand really, and not really dive into what is actually the markets, macro market happen now. Okay, but at least you need to know the fundamental of the so-called on the financials, financial instruments or financial investment instruments that the things that drive the prices. Okay, the fundamental is actually on the monetary systems and also the policies. Okay, the first, of course, there is actually others like fiscal policy and others, but we talk about the main fundamental first is actually monetary policies. So globally, now we since last year, US are in an aggressive rate hike. Others are essentially in follow. Okay, beside of rate hike, the others third type of tightening is actually quantitative tightenings. So now in this year, it's actually very aggressive, especially within these two months, it's very aggressive. And ECB also talk about in a tightening, they want to bring forward the tightenings. So with that, okay, so you will see that on the liquidity has been in the world has been shrinking. Okay, so once shrinking, so with the inverted yield curve led by the US and also the developed markets, so what you can think of, you have the shorter end, you have a shorter end, a more attractive type of yield. Okay, so means that the 3 months or 1 month, 3 months, and within a year type of treasury yield is actually more attractive than your longer tenure, right? So with that, so what you would think of, people will just fly off to the shorter tenure type of things. Okay, so that is actually the first opportunity until the yield curve, as I said, you get normalized back to normal. So once it's actually back to normal, then your growth stocks, growth stock, long tenure type of real estate type of investments, then the attractiveness will be a rise after that. So for now, I would say short term, still more towards short tenure of bonds, more towards like if you have an opportunity, then you can expose some of your foreign currency to cash. Okay, if not, then a high quality stock that to withstand so-called the current short term, the environment. I'm not talking about long term. So that is actually the short term opportunities that you can look into it.
Okay, we have at least 9 questions. So I'm going to just ask the panelists to no more than 3-4 minutes, If not, you just hound them when they walk through the door and don't let them leave. They don't answer your questions properly. The top one is, if the fund have heavy redemption compared to the amount of investment received, is the fund manager able to manage the fund well? Anybody? 3 minutes, 4 minutes.
Okay.
Okay.
Yes and no. Because whenever we manage a fund, we do have some liquidity provisions for the fund, right? To basically meet redemption requirements. Depending on the fund, of course, equity, balance, multi-asset, fixed income, it could range between 10 all the way to 20% of cash, basically, to meet those requirements, or liquid assets, for example. However, like what you mentioned just now, it does become a problem. Say there is a crisis in the portfolio. Say the fund holds a big chunk of Country Garden, right? Country Garden, the bond is in trouble. There's no liquidity, but because it's there, everybody wants to redeem the fund. So that becomes a bit of a problem. Yes, we do understand because we have to sell our winners, right? So until the problem of that particular security is being fixed, is being solved, then the fund manager would have to be forced to sell the winners. Unfortunately, when that happens, the people or the investors that did not redeem would suffer a bit more than people who did. Right? So you want to stay, you believe in the fund manager, you believe in the strategy. However, because of a problem and heavy redemption happens, we have to sell. So yes, if the fund is big enough, it manages to cater to that heavy redemption. So even during the year, say the fund is 2 billion, there's a heavy redemption, but the liquidity provision is there, then it's okay. But if the fund is small-ish and it's an exposure, there's a crisis in the portfolio, then it becomes a bit of a problem. Then, of course, it wouldn't be managed well.
Okay, Jerry, this for you. 3-4 minutes. Can you share your perspective on what constitutes a strong investment portfolio and how it might vary for different investors?
All right, maybe I answer the second part. How it might vary for different investors. I think the very important factors to look at this question is the risk profile of the investor. We don't have a best portfolio for everyone, or we don't have a strongest portfolio for everyone. It actually varies from A investor to B investor, because if you look at the risk appetite of the investor, that's a very important thing, and also the time horizon that they can invest. If I can stomach higher risk, potentially I will have higher exposure to equity, more exposure to the growth-oriented one, because we know on a longer-term perspective, they could be the winners. So a strong investment portfolio, I think it might consist of bonds and fixed income at the first place. You need some diversification between asset class. And then within your fixed income, you need to have some driver, the yield enhancer, which is probably your emerging market bonds, your global bond, which if you look at it right now, if you invest into global IG, investment grade, you are getting 7 to 8% kind of a yield. Malaysia bond, it gives you a 4 to 5%. So it's good for investors to have some exposure to investment grades on the global context. Then on the equity side, I think at this point in time, you couldn't ignore the main one is your technology. And then your US, I think at this point in time, we are also favoring Japanese equity. So I think proper diversification have to be there. Make sure that the correlation of each of these asset class and exposure that you are having, they are less correlated with each other, to make sure that when things happen, when something bad happens, they are resilient enough. I think those are very important things, because when investors, when they construct a portfolio, right, they tend to go after the highest return, but they ignore the fact that they couldn't stomach that kind of a risk. So I think those are really important factors to consider.
I like what Jerry said. If you want decent return and you are a little bit risk adverse, that's what I picked up from his conversation. High grade offshore bonds are giving you 6 to 7%. Or I heard you wrongly or heard you correct? Yeah. So then maybe there's one thing that one can look at for 2024 in terms. Okay, I'm going to go back this way. Okay, well now. I'm going to ask you the middle one. Can you discuss any specific investment themes or sectors you believe have a significant potential in the current market environment? Sorry, I had to choose this one for you.
I think for us, I think in terms of sectors, in terms of the themes, I think fixed income is still a winner for the next couple of months, right? At least for the next 18 months. I think with interest rates are expected to be cut sometime next year, I think interest rate has some legs to run. Again, like what Jerry said, they can fetch about 7 handle now, and there's some potential of some capital gain as well with fixed income going forward, both even locally as well as globally, US dollar fixed income as well. In terms of themes, I'll be very honest with you, since consultants are here, I'm a bit wary of themes lately, because I think back in 2020, 2021, there were a lot of thematic funds, too many. Right? But if I have to pick a theme this time around, because I do like the social theme when it comes to strategies. We have a lot of technology theme, ESG themes, and stuff, but I like the social themes when it comes to food food generation, global lifestyle, for example. I like those themes because I think it is more relatable, and I don't expect to invest in themes in a near term to medium term anymore, because that was the pitch back in a couple of years back. You invest in this theme, you make money. There are some themes that you probably can bet on. I personally don't like it. I like themes that are more relatable to the individual, but those are the two things. Fixed income, in the terms of sector, that's probably the best bet. Themes, I like social. Yeah.
Okay, Charles, back to you. Because this person put his or her name Cheong, so we need to answer a question. The rest are all anonymous, but we'll try our best. How do we detect the fund manager overexpose risk on specific funds? How do you go through their prospectus and decide?
In
the
my
term sheet?
side, usually we will compare with the peers of funds. So usually if the mandate roughly, let's say, talk about local bonds, we have few fund house, we have few local bonds fund as well. You put side by side, if the funds, let's say the funds, the AUM side is almost the same, then the performances should be almost the same, because it's actually local mandate with a so-called similar strategy. Okay, but if you see that sometimes if the funds outperforms, okay, it's very let's say we don't talk about bond, we talk about equity funds. So if the funds that is really, let's say, if local equities, or we talk about local equities, if all the peers averagely score about 12%, 12 to 13, about that, if a fund actually shoot up to 20%, okay, so then we should analyze what does the fund manager do well, okay? Does it overexpose in a single so-called single stock of, one or two stock that give you the fantastic result, or vice versa? If the funds averagely is actually making a loss of 8 to 10% on the peers, but your fund is actually making a loss of 20%, okay, the particular funds making a loss of 20%, then we also should use a similar strategy to analyze, is it they overexposed? The main thing is actually always will be more towards overexposed, overdone, overtaking risk. Means that the fundamental basis is actually overtaking the risk. Okay, so then as investors or as the so-called advisors, you can check on the so-called on the fact sheet levels, or even you can ask on your so-called on the respective connection to the investment team to get certain answer on that. So then you can gauge whether or not it's actually overexposed. Yeah.
Thanks, Charles. I guess, to me, the best thing is that whenever you receive the term sheet reporting on a quarterly basis, look at the top 10 holding. It will give you a pretty decent idea. Now, there's a person by the name of YT, and I'm going to go back this way. Can you share your view on inverted bond yield curve? Based on history, inverted bond yield curve as indicators, they are indicators for market recession. How do you manage this risk, Bel? And after, I'm going to come to Jerry for the next question. Okay, I'm being fair.
Yeah, I think currently, like I said, yes, it is a signal for a recession. The disappointing or the frustrating thing now is the inverted yield curve has happened, but the recession has not, right? To a certain extent, I know I say this in some forums. I want to get the recession over and done with. Right? Let's get the recession done, and then we can move on, right? It's like a bad breakup. But in terms of managing it, I think I've mentioned it earlier. It's not any different when you manage a portfolio in a recession or in a market downturn. It's the same thing, right? In terms of diversification, in terms of asset allocation, it is very important. In a recession, of course, there is a unique thing where all asset classes tend to not perform. That is the unfortunate thing. So in the near term, usually we use a lot of cash as tactical play. Again, that's back to asset allocation. Again, back to the portfolio or the fund's objective. If it's a If it's a passive fund, index tracking fund, that's not much you can do, unfortunately, because you have to follow whatever the fund or the index or the ETF is doing. But if it's an active portfolio fund, you can take a bit of risk. I don't mind fund managers being super defensive, right? I don't mind fund managers being a bit more conservative if they don't know where the market is going, right? We might miss opportunities on the upside, sure. Manage it as what you are comfortable. If you don't know, then be defensive. So we do that with asset allocation tools, like I mentioned, some vol caps. We use quant and stuff like that to basically determine when to go back in, because we have, as a fund manager, we always have this point where it's easier to manage a fund when you don't capture the upside returns, rather than explain to the client why you lose their money, right? So being super defensive looks bad sometimes, but so what, right? The heartbreak wouldn't be as bad as you losing my capital, right? This fund manager did 10, I only did 5. Okay, but I didn't lose you 10 last week, right? So managing it should be the same. It's not any different just because there is a recession, but I do hope, recession should just come lah.
Okay, I said, Jerry, right? I said this way, right? Okay, how do you balance between using an algorithm portfolio or a manual portfolio management strategy? Or do you balance it, or how do you advise your relationship managers to advise people?
Yeah, I think I can answer in a pretty short way, because for us in iFast, we don't really practice algo. We still very much believe in fundamental investing, and also it's everything more done by human. The tech part is really helping us to cater more on the operational thing. When we do rebalancing, these are all the tech that come into the picture to ease the operational hazard. So for us, we still pretty much believe in fundamentals. And I think one point that I want to point out is that if you look at a lot of the so-called algo fund in the markets, right? Yes, no doubt that when market is all the way down for a year or 2 years, right? This kind of fund will be able to avoid losses for investors. But when markets start to rebound, on the turning point itself, you will start to notice that the fund will lag behind capturing the rebound. So on a longer term perspective, you will see things will actually even out. So for us, we don't really practicing so much on algo. Like I mentioned, it's more really on value and fundamental itself.
If I can add on that, I mean, I just wanted to share. We do use quant and AI as well in our fund management activities, but we combine both, right? Because sometimes to look for opportunities, to look for stocks, to screen for it, especially when you're managing a global fund, is pretty slow. Being here in Malaysia, we don't have a global network. Using quant AI, multi-factors is very helpful. However, the decision made by the fund manager to invest, or by the analyst to make the call to invest into this stock, needs to be on an active or bottom-up perspective. So it's a combination of qualitative and quantitative. Right? So we combine both. So it is quite helpful, actually. Yeah.
Okay, there are 4 questions left, and there are 9 minutes, so anyone can choose it. And don't take more than 2 minutes, okay? Most investors are not getting what they want by exercising the DCA. Can you share a more systematic way to earn profit significantly by investing in trust funds?
Okay, I will take this. Okay, the exercising of DCAs, most of us is actually done in unsystematic way. Okay, so how I say unsystematic way is actually, so the fund is actually, let's say the portfolio of funds drop 5%, you go and dollar cost. Drop 3%, you go and dollar cost. Drop 6%, you go and dollar cost. Definitely, you don't have the unlimited bullets, okay, or I will say unlimited capitals. So what I will share with you, what is actually the strategic or a systematic type of dollar cost is actually, you can use markets. Let's say you are investing in Asia funds. If the Asia fund is actually benchmarked with the Asia indexes, let's say FTSE Asia ex-Japan, Asia Pacific ex-Japan. You use the Asia ex-Japan, from which point you have invested, from the top, you measure down for 20% to 25%, you do one-time dollar cost. Because in bear markets, if you really calculate, small bear market is actually 20-25%. if a big bear market comes, it's actually roughly about 50, 60, or even 70, so it depends. Okay, so if you really practice 20% you dollar cost once, or 25% you dollar cost one, then it not cost you unlimited capitals. Maybe if you have dropped to 60%, so either you practice 20% you dollar cost one, you only cost you 3 times of your dollar cost. And if not, 25% is actually 2 times. And usually dollar cost is not 1-to-1, or not 1-to-2. I mean, if you invested 100,000 in a portfolio, you do dollar cost is 100,000 or even 200,000. If either you have a deep pocket, then you can do that. If not, at least 50%. Because as I did calculated the capital efficiency ratio, you did 50% on the initial investment, that is actually fine enough. So that is actually the strategy dollar cost. So what question again? So can scroll down.
The question they have disappeared. So because
back.
once the question comes out, it's disappeared. I need to go back to the other questions.
Okay. So that is actually on okay, dollar cost. Okay, so that is actually how you effectively do dollar cost, and eventually market is actually move in cycles. Okay, we are just in so-called in a very competitive. I would say is more challenging. It's actually very challenging type of cycles. Okay, so as what Bell has been said, we would want the recession just come and then go team and then we just recover from there. Okay, settle, we recover from there. Then we will be back into a normal cycles. Then we can invest accordingly. But now we are in a very challenging. So dollar cost, try not to blunt on it. Dollar cost systematically, okay, by percentage. Okay, then you calculate the percentage. Then it's all right.
Okay, we got 5 more minutes. I hate to play God, but I have to play God, so I'm going to choose the questions, okay, because there's no time. Can any one of you can answer this, can you remove that cursor? Can you share more on normal investors? How should we use the strategy of asset allocation or tactical asset allocation to help our portfolio? Anybody?
Yeah. So for us, right, I think the first one is actually strategic asset allocation. So on a strategic asset allocation perspective, on our end, we are more following the GDP weighted approach. So meaning we use the global GDP to weight our strategic asset allocation. But when it comes to tactical asset allocation, we base on the outlook of the respective markets. So maybe I share a little bit. At this point in time, we are overweighting first Japanese equity. Second, we are overweighting technology sectors, particularly on semicon since early of the year. Then we are underweighting China. We are having most of the neutral allocation for the rest. So tactically, is something for 6 to 12 month kind of investment horizon. So right now we are overweighting the Japanese equity, the technology sector, underweighting the China. And for the bond side, global bond, we are more overweight. We are tilted towards the short duration. But for Malaysia bond, we are more tilted towards the long duration. Because if you look at the yield curve environment, yeah, I think just now you also mentioned about the inverted yield curve in the US side. So on the global end, we are more towards the short-ended. And on the local end, we are more towards the longer end for a tactical positioning.
Strategic asset allocation long-term, tactical asset allocation 6 to 12 months. Yeah. Okay, Well, this is for you because you're the CEO. Are you facing challenges in terms of competency or skill set in specific area of ESG and SRI?
Yes. The thing is, because we are in the ESG and SRI framework or journey, we in Malaysia, we have just started, right? Our partners, our investment managers that's globally, they have done this for 20, 30 years. So to find talent, the skill set, it's not just tough to find them, it's very expensive when we do find them, right? So what we have done is, unfortunately, this is how we have to learn. We partner with global fund managers. We have to learn how they do it, and basically, in other words, copy paste, right? Unfortunately, because it takes a while for this group of talent to be more competent and more skilled. I think SIDC is doing a really good job in doing this as well, trying to get more people into the sustainability expertise. But it is a challenge, right? Even internally, what we're doing here, we use third-party data providers, and we train our fund managers and analysts to do so. But compare that to what the BlackRock, the Schroders, the global asset managers has, we're nowhere there. It takes time. We need to expedite the whole process. And if any of you are ESG experts, please send your CV, because I am looking actually.
Thank you for being so candid. I like his answer, cut and paste. Okay, very good. Charles, is passive ETF or active dynamic portfolio management back in trend, especially in volatile market cycles like now?
Yes or no, I will say, okay, because the current cycles, as said, is actually very challenging. We have inverted, we are in the inverted yield curve in the developed markets, right? So if you are doing passive investments, of course you can go for those are passive, right? Those is really not. I would say if you go passive enough, you will just follow the so-called what the markets are doing. But if you're doing actively, okay, because of some sectors or some regions that is really doing well. So if you really passive in a global, or if you're skewed towards into a region passive enough, then you might not get the returns in this year or maybe in coming next year. But if you really do half of it dynamics, you tactically have some so-called have some tactically weighted into a certain region that says like where is actually the funds goes, okay? So then you will be benefited, okay? You can stay put in your passive, but try not to, 100% passive. I would say that.
We've only 1 minute. So for the last question, how does fund manager evaluate which stock to dispose or acquire? Does it need to follow the market trend? Being an ex-board member, so I tend to ask all these questions, you see. So why don't I just give you a 30-second take on that? Firstly, there are a lot of tools that they all use. Quantitative, AI, and they sieve out truckloads of things, look at historical trend to see which fit what cycle. So you've got a base load already. But from the base load, you need to have a qualitative overlay, which all of them are saying. If you don't have either, then you're shortchanging yourself. And to the fund manager who say that I follow the market trend, I will fire him. Because if you follow the market trend, means you have no conviction. And so I would never listen to somebody say that I follow the market trend. If you follow the market trend, means you are just a so-so fund manager. Okay, that's it. We only got 4 seconds. And with that, I'd like to thank all my panelists. Thank you for all the interesting questions. Thank you very much. Round of applause to all the panelists.